Welcome everybody to 15 Minutes of Finance, where in the next 15 minutes, I'm gonna get you excited about investing. Let's do it. Okay, today we have a whole bunch of stuff going on, so I wanna just jump right into it, and we only got 15 minutes to do it. So, term of the day is gonna be a 10Q. All right, write this down, commit it to memory, whatever you need, okay? A 10Q is a company's filing report that they do every quarter. All right, and that's what the Q means, is quarter. I don't quite know what the 10 means, but 10Q is the filing report that a company goes, a public company gives to the SEC every time they report earnings. So what does that mean application-wise, right? Well, that is when you hear, a company's giving their earnings, or a company stock just blew up 20%. They had great revenue. They made so much profit, et cetera, et cetera. That is from the 10Q filing and their earnings report that they give to the public. So that's important today because Trump, the administration, just recently announced that they might get rid of the quarterly requirements for companies. And if they do that, that's going to change so many things for analysts, investors, money managers like myself. It's going to change a whole bunch of our approaches to managing money, because I think he wants to move it to biannually, so twice a year. If that happens, guys, that is going to change so much for us. For me in particular, I'm going to get less data. I'm going to get less information throughout the year that is telling me important qualitative information and fundamental information of the companies. So it's going to be harder for us to make picks, to make good assessments on companies. Now, what does that do for the companies? It does do a few good things for them. It's very expensive to get audits done and to get this information all compiled quickly. Essentially, when they're done with one quarter, they start figuring out how they can assess the next quarter. So it is kind of an expensive and urgent thing for each of these public companies. I think they would benefit from a biannual, but traders, day traders, even fundamental investors like myself, I think we will struggle to get really good information out of 2 reports a year. So anyways, 10Q, that's important for now, and it might just become a biannual thing here if the administration does that for the companies. Okay, let's jump right into the news. We had a big week, right? Interest rate. Last week we had a very quiet week where what did we talk about? We talked about buy the rumor, sell the news. Well, last week were all the rumors. This week was the news. So let's go over what is happening. Okay, major stock indexes set all-time highs for a second straight day Friday, with the S&P 500 and NASDAQ Composite registering a third consecutive week of gains. The tech-heavy NASDAQ and benchmark S&P 500 closed 0.7% and 0.5% higher, respectively, while the blue-chip Dow Jones Industrial Average ended up 0.4%. All three set both intraday and closing records for a consecutive session. That is such good news. The small cap Russell 2000, this is actually kind of cool. The small cap Russell 2000 index also hit a record high Friday before turning lower and ending down 0.7%. So let me interrupt real quick. The Russell 2000, I had heard that like in the last 25 years, I think it was like 17 years ago, that there was an all-time high for the Russell 2000. So the Russell 2000 has had a rough go, and they just hit an all-time high, which is obviously very exciting. It seems that everybody and their mother is making money in this expanding market here. So, okay, let's get back to it. The S&P 500 and NASDAQ had closed lower in Wednesday's session after the Federal Reserve cut interest rates for the first time since December, but rallied yesterday as technology stocks surged on news that NVIDIA would invest $5 billion in embattled chipmaker Intel, INTC. Shares of Intel had soared nearly 23% to lead the S&P 500 NASDAQ, but finished down more than 3%. NVIDIA stock, which gained 3.5%, was one of the top performers in the Dow on Thursday, ended up 0.2%. President Donald Trump said that he and the Chinese Xi Jinping confirmed a deal that would see TikTok avoid a U.S. ban. Everybody loves that. Well, a lot of people love that, especially the youngos. Shares of Oracle, ticker ORCL, which reportedly will be a part of a consortium to control the social media sites' U.S. operations, closed up 3%. And other corporate news, Apple shares rose more than 3% as its new iPhone 17 models went on sale globally. FedEx stocks advanced 2.4% after the delivery giant reinstated its full-year outlook. And shares of Lennar, which is a building company, shares of Lennar fell 4% after the home builder's quarterly revenue and profit came up short of expectations amid sector struggles. The 10-year Treasury yield, which affects borrowing costs on a variety of consumer and commercial loans, was at 4.13%, up from 4.11 at Thursday's close. Gold futures rose 1% to $3,720. At 4 p.m. Eastern Time, Western Texas Intermediate futures, the U.S. crude oil benchmark, was down 1.4% at $62.70 a barrel, 62 spot 70. That's important because like $67 is kind of the sweet spot if you're in the oil industry. Usually when inflation hits oil, that sparks and spikes the barrel cost for oil, which obviously that's good for the oil companies and the oil stocks because that's a commodity. It's a little different than the other growth companies. Bitcoin fell nearly 2% to 115,300, and the U.S. dollar index, which tracks the value of the greenback against a basket of foreign currencies, hit its lowest level since early 2022 Wednesday. And it was up on Wednesday, it was up about 0.3% to 97 spot 65. Okay. That's the news. A whole bunch of stuff happened this week. I do quickly just want to talk about interest rates. Everybody talks about interest rates. It's the talk of the town. It's important to understand a few things about them. So right now, if you look at headlines, you'll find 50% of the headlines saying the S&P 500 is going to double. You'll have another 50% of stocks or of headlines that'll say the market's going to crash. What's going to happen, right? We have Ray Dalio warning people to get out of the market. He doesn't want to invest in stuff. Ray Dalio is one of my favorite investors. He's one of the best ever to do it. I don't agree with him in this situation. Michael Burry, I think that was his name. I keep wanting to say his name is Blueberry, which is not it. It's Michael Burry. I'm 99% confident. He's the guy that got the mortgage-backed securities bet correct back in 2007, 2008. He also is betting against the economy right now. So there are big players saying this isn't going to go well. The market's going to crash. All year, those people who have betted against it or shorted it have suffered some big losses, all right? Because the market just keeps ticking up. A lot of that has to do with the encouragement or the excitement about interest rates. I love the idea of interest rates dropping. It means more money is in the economy, more money is flowing, more people are buying stocks. I love that. Before interest rate drops, there was $7 trillion on the sideline in cash, just waiting for rates to drop. That means there's more money now in play. That's going to rise. That's going to tick stock prices up. It will carry the market significant percentages higher than where it already is. Now, I do want to say there's two really big concerns that I have. The first is stagflation, which is important to learn because it pretty much affected all of the 1970s. Nothing really happened. Okay, it was just kind of like stuck. And that's what like the stag and the stagflation is. It's stagnant. So it's kind of like you're just stuck, right? Think of purgatory. You're not in heaven, you're not in hell, you're just in the middle somewhere waiting for something to happen. So stagflation occurs when there's high inflation, which we are in a high inflationary period, and recent data has suggested it's increasing, and then high unemployment, which we definitely have. This is why we got lower interest rates, is because of the high unemployment, right? So the Fed, which is just the U.S.'s central bank, their whole job is to be a last second or a last resort if economies aren't doing well. So when there's high unemployment, right? So there's people who just aren't working, aren't having jobs. The Fed might say, oh, well, let's make an injection, right? So they'll lower interest rates and it allows people to borrow money at a cheaper price. That typically stimulates growth, stimulates expansion, and that allows for unemployment to decrease. So what happens with stagflation is you have high unemployment, you have high inflation, and the economy stops expanding. And it doesn't necessarily contract either. It just sort of like stays still, right? Because typically, I think it's called the Phillips curve, which we talked about a couple episodes ago. Usually high unemployment means low inflation. That's what they thought before in the 1970s. 1970s happened. Now we have stagflation. So anyways, that's one really big concern I have. The only way to really fix it is you have to tread carefully. You can't make these big interest rate drops. I could see a 50 basis point drop, but I don't see it anytime soon. Maybe in 2026 when we get this inflation taken care of. And then lastly, this is more speculation based upon actual data, but it is just a little bit sentiment that I have that I want to talk about. So since 1945, there's been 12 recessionary periods, approximately. 10 of them have been preceded by interest rate drops, right? So an interest rate drop happens, within 5 months, boom, recessionary period. That's happened 10 out of 12 times. Definitely not saying that's going to happen this time. Probably not, simply because we have innovation. The way technology is changing the economy, the markets, our daily living. I mean, think about how often we're on our phone now compared to 2012. It's exponentially more because there's just so much more technology can do for us. I think that's really going to affect all of the market movement going forward. I kind of feel analysts and economic history, they have a much, I don't want to say less, but it's a much more confined point of view, right? No one's ever seen this advancement, this with AI and generative AI, general AI and super intelligence AI. No one's ever seen this kind of expansion before, this innovation. I think we're in unknown territory, and we can't say just because in the 1970s, therefore in the 2020s. I don't think it works that way anymore. I think we really have to be careful dissecting and assigning certainty to different points of view. So those are my two hesitancies. I'm still very excited. We're very bullish. I actually think innovation is going to overcome any kind of bad news. So any sort of market drop, us at our firm with our clients' assets, we have cash ready to jump in because we're so excited. We're thinking, look, everything about, well, I don't want to say everything, but we are moving from a consumer economy to a producer economy. And when you do that, just like in the 1920s, okay, when everybody hears about 1920s, they think about the Great Depression that started in 1929, or at least the signs started showing up. The other 8 years before that, from 1920 to 29, even just the whole decade of the 20s, was booming. Absolutely incredible for everybody. That is because they were in production mode. And so we have now transitioned ourselves to production mode as an economy. That's going to be great. And with innovation of technology and AI and just everything that we're trying to do where it simplifies our daily life, it's going to be incredible. And that's what we believe. So I'm very, very excited. We're very bullish on the market going forward. And I think you guys should be too, especially if you're a retail investor, right? We manage money. We're an RIA. We invest people's assets. They come to us. Hey, we don't want to do it. You do it. They pay us a fee. I think everybody can do it themselves. Okay. So if you're watching this and you're doing it yourself, you can do it. Just make sure you spend the time. Okay. You spend the time. You got to read stuff. You got to get educated. You got to listen to podcasts like this, and you got to stay on top of stuff. If you can do that, you definitely don't need to hire someone like me. I obviously want you to, but you don't have to. You can definitely do it yourself. Okay, so one thing we've started doing in the last 2 years is a stocks to watch list. Now, legally, I'm not allowed to provide advice. In fact, I'm supposed to say that basically every time I get in front of the public or in front of a camera and there's a recording. I'm supposed to say everything I say is not financial advice. It's simply educational. However, for us, we do have a stocks to watch list that we do publicly put out, and we put it out on our podcast. All of our episodes are audio only before this one, and you can find them on Spotify, Apple Music, anywhere you listen to podcasts. We even have them uploaded here now on YouTube, but you can go back and check our history of our stocks to watch. It's pretty darn good. Okay, it's very, very impressive. Now, I will tell you, every client that we manage, they don't have all of these, right? Some of them, based upon their risk tolerance, have higher weighting or higher allocation of certain positions versus others. This list that I want to share with you guys today is just free information, and we're going to do this till the end of the year, right? So every month we're talking about stocks to watch. I'm going to give you guys all of our picks from this year. And last year, I mean, we had great picks: Palantir, SoundHound, NVIDIA, Costco, Kava before it tanked this year. And we had some bad picks like Novo Nordisk, right? So we definitely, for the most part, this is what we love to do. And so I hope you guys take this stocks to watch list and you really dissect it, because these are the stocks we think long-term are 10 baggers. A 10 bagger is something that's going to 10x, or that we at least think is going to 10x. And we spend all day, every day, early in the morning while you're asleep, dissecting and listening to the market news, reading the fundamentals, reading the 10Qs, the 10Ks, analyzing future cash flow, discounted cash prices. We are going through the fundamental process of analyzing stocks. So I'm going to give you the list of what we have so far, and there'll be more, okay? But listen and look at these lists. And if you want evidence that this isn't just cherry picking, go listen to our other episodes, okay? There's probably the last 20 will give you a good insight of the stocks we're picking. But I mean, we do an episode multiple times a week, if not just every week. So there's 52 from this year. Well, not 52. We're not in December yet. There's 36 already. I didn't do the math, but it's probably around in the 30s. And you can check, you can validate that we said these things before they took off. And I wish I could show you client accounts, but obviously I can. That's a violation of privacy to validate it. So United Health, okay, the second that stock hit 50% off from the unfortunate incident that occurred earlier in the year, we put that as a buy signal of interest for our stocks to watch list. Okay, that is one of the most undervalued companies. They have excellent fundamentals, excellent revenue, almost no debt. They have incredible profit. That is one of the most value stocks I've seen in many, many years. Warner Bros. Okay, they're going to potentially get bought out. We were looking at them at $7. Okay, I think now they're at $19. Goldman Sachs. This is the most recent addition that we want to put in. That's a financials company. With interest rates dropping, all of financials are going to probably benefit from it. But I think investment banks like Goldman Sachs, and then small players like SoFi. SoFi is all over the retail trading space. We've liked SoFi since $11, and now it's near 30. It's still a buy, in my opinion. It's trying to change the game. It's trying to change the game of banking, which sucks. The banking world is full. The problem with the banking world is that they're too far removed from the actual customer. And so they do view every account as a dollar, when really that account represents a human being. And so they're trying to just penny it, nickel and dime, everything they can out of each account. I think SoFi is trying to change that, bring everything online, try to make things as transparent as possible. So that's one of the reasons why we like SoFi. AT&T. I put this pick on here because I doubled down. I didn't want to repeat any of our picks from 2 years ago, from 2024, but AT&T is without a doubt one of the best dividend stocks you can own. When we initially had started talking about it, it was at $16, $17 with a 6% dividend. Okay, now it's at $30, near $30 with a 3% dividend. So obviously not as great as it was, but I still fundamentally believe in the company. They've cut almost all of their fat out, and they are focusing on their 5G and their wireless services, which I love. Stick to what you know, become an expert. CrowdStrike, easily one of my favorite companies for this year. Everybody needs security, especially with this AI infrastructure expanding, with all these data centers and NVIDIA just expanding in this space to basically become an absolute priority. The CrowdStrike is going to be a critical factor. And there's a couple other competitors in the security space, but data analytics security is huge. CrowdStrike is the trailblazer. They're the best so far. And, subjectively, I would say that stock for us is killer. And then the two energy companies that we have, Talon Energy and Constellation Energy, all of this data center in this AI space, even in the crypto space, the biggest setback is how much energy it takes. Well, guess what you're going to need? You're going to need energy companies. Guess who are the two best in this space? Talon and Constellation. So we've really liked them since the beginning of the year. Definitely worth checking into. And then I'll just combine these three at the end. HIMS, BBAI, which is Big Bear AI, and Tesla. Okay, all three of them, very, very volatile. There's an immense amount of opinions on these things. Three things that make them very, very unique. They are breaking into spaces that are very difficult to break into, and they're very unique. They're carving out a moat or a competitive advantage, each and every single one of them. Tesla, I'll deep dive into this real quick. Tesla is not a car company. Okay, do not think Tesla sells electric cars. Okay, Tesla is a data AI robotics company, self-driving vehicles, battery packs, efficient battery packs, robots. All right, that and the AI with Grok, and that'll probably all be implemented eventually. But Tesla is a robotics AI data company, and they will, without a doubt, in my opinion, be a $10 trillion company in the next 10 years. Okay, so that's the number one reason. Even with the volatility, even with the PE ratio, et cetera, et cetera. Anyways, that's our list for this year so far. And I'm excited to add to the list after that. So, all right, guys, please take a second, leave a review, do something. Okay, give a thumbs up. Tell me my hair looks bad, that I'm balding. I don't care. Do something. We are expanding here from audio only to YouTube. This is our very first YouTube video. We're very excited about it. And we're looking forward to providing you guys some information and helping you become better investors. All right, guys, that's it for today. As always, invest early, invest often. We'll see you next time.